Managing Director of Equity Research at TD Cowen. He's an analyst who covers the space. Menno, thanks a lot for joining us. First of all, let's talk about the Canadian E&P space in particular, the oil and gas producers. As you've noted in some recent commentary to clients and people who read your notes, the Canadian Energy Index has significantly underperformed the U.S. Energy Index, likely on the tariff story.
Yeah, thanks for having me on, Paul. To your point, it's been a shaky start to the year. We've seen pretty significant underperformance of the Canadian producers, and the big issue there has been the tariff risk that initially emerged on January the 10th. And just to put some numbers to that, we've seen the Canadian Energy Index underperform the U.S. Energy Index by roughly 8% on a U.S. dollar adjusted basis. And when we run the math on the potential hit versus lost market value across all of our coverage, it does tell us that most of the tariff-related downside is captured. But I've learned over the years that the bad news is never fully priced in. So we'll see what happens on Tuesday, which is the next key day in this saga. Just to quickly touch on valuations, we do see good relative value within the Canadian space. On average, we see the Canadian E&Ps trading at roughly a 1.2 turn multiple discount to their U.S. peers. And that's a significant discount because there was a time in call it 2024, where the U.S. and the Canadian names effectively traded in line. And then we're also seeing good value in absolute terms with our coverage trading at, call it 10 to 12% strip-free cash flow yield on total CapEx. So notwithstanding the current valuation gap versus the U.S., we think investors will need some patience, and we do think volatility could persist until we have better visibility on some of these outstanding issues.
There seems to be a never-ending debate on whether the supply-demand fundamentals for oil in particular are constructive or not. Is the market oversupplied or not? Where do you come down there?
Yeah, I mean, the big shift in the supply-demand conversation of late has shifted to demand. And I think the very simple thought process is that we've seen enough in terms of tariff rhetoric for a lot of people to believe that this becomes a sort of a widespread global phenomenon. And of course, if under that scenario, you do have to start to worry about global economic growth. And to the extent that global economic growth starts to roll over, then of course, that's going to directly impact oil demand. So I do personally worry about demand when you think about what we're seeing right now relative to what we're running in our current price deck. We're pretty much capturing that. We're running $71 WTI for 2025. We're a bit lower than that today. And then longer term, we have it backwardating to about $65 a barrel. Okay, let's go to MEG Energy.
What were your impressions of those fourth quarter results?
Yeah, so just for some very quick background for everybody on the line, MEG it's a very simple story. They've got a single project. They are a pure play SAGD producer, and they IPO'd in 2009. They have a very long history of hitting consensus expectations on the quarter, or even beating. And that's one of the reasons I've liked the name over the years. As you mentioned, they did report last night. We are seeing some weakness today, call it down 2 to 3%, depending on when I'm looking at my screen. But I'm not sure that's justified. When I look at the headline numbers that they posted last night on production, on cash flow per share, they were relatively in line. So I'm a bit confused by the underperformance. In terms of what came out of the conference call, the one focus area, not surprisingly, is access to overseas markets. Through the West Coast. They do have 20,000 barrels per day of commitments on TMX, and through the U.S. Gulf Coast, where they do have export capability as well. The other focus area, which is an important one, is the growth outlook through 2028 for Christina Lake, which is their flagship project. And the good news there, I think there was a little bit of confusion on whether CapEx had changed on that growth, but they made it very clear on the conference call that it had not. And everything on the growth front is effectively tracking per hour expectations, and that's an important piece. So I call it fairly uneventful. Again, I'm a little bit confused by the underperformance today, and I'm certainly telling people to buy on this weakness.
Menno, thank you a great deal for joining us today. Menno Hulshof is Managing Director of Equity Research at TD Cowen, and as you just heard, an analyst who covers